Hello and welcome back to the podcast. I am truly glad you are joining me today. We are about to dive into a topic that is probably the most requested subject I get asked about in the current market. We are talking about your home equity. We are talking about the wealth that is sitting right underneath your feet, locked inside the walls of your house. Specifically, we are talking about the VA cash out refinance. Now, before we get started, I want you to take a second and think about your financial picture right now. If you bought your home 3, 4, or 5 years ago, you have likely seen something incredible happen. You have seen the value of that home skyrocket. You might have bought it for $200,000, and today, Zillow tells you it is worth $350,000. That difference, that $150,000, that is your equity. That is real money. It is part of your net worth. But here's the problem. It is illiquid. You can't spend it at the grocery store. You can't use it to pay for your kids' college tuition. You can't use it to fix the leaking roof. It is just a number on a screen until you do something to unlock it. That is where the VA cash out refinance comes in. It is the key to the vault. But, and this is a massive but, using that key comes with a cost. In today's interest rate environment, that cost can be steep. We are going to spend this entire episode breaking down exactly when it makes sense to pay that cost and when you should absolutely, positively leave that money alone. This is episode 23, Cash Out Confidence. My goal is that by the end of this 25 minutes, you will know exactly what to do with your equity. Let's start with the basics. What exactly is a VA cash out refinance? It sounds simple, but people often confuse it with the IRRRL, which we talked about in the last episode. The IRRRL is just a rate reduction. You keep your current loan balance, you just lower the rate. It is fast, easy, no appraisal. The cash out is a completely different beast. In a cash out refinance, you are literally taking out a brand new mortgage for a higher amount than what you currently owe. You use that new, bigger loan to pay off your old, smaller loan. And then the difference, the cash, gets wired directly to your bank account. Here is the superpower of the VA cash out, the loan to value ratio. In the civilian world, with a conventional loan, banks get nervous. They typically only let you borrow up to 80% of your home's value. They want you to leave 20% of your equity in the deal as a cushion. The VA is different. The VA allows you to borrow up to 100% of your home's value. That means if your home is worth $400,000 and you owe $200,000, you could theoretically refinance for the full $400,000 and put $200,000 cash in your pocket. Now, just because you can do that does not mean you should. And honestly, most responsible lenders will cap you at 90% anyway, just to keep you safe. But the option is there. It is a level of flexibility that civilians just do not have. So why is this such a hot topic right now? Why is everyone talking about cash outs? It comes down to debt. We are living in a time of high inflation. Groceries cost more, gas costs more, insurance costs more. And for many families, that extra cost has ended up on credit cards. I want to share a story with you. This is a story about a veteran we will call Mark. Mark served in the Marines. He bought his house in 2020. He got a phenomenal interest rate. He is sitting at 2.75%. His mortgage payment is $1,200 a month. It is beautiful. He loves that rate. He tells his buddies about that rate at barbecues. But while Mark's mortgage is low, everything else in his life got expensive. Over the last 2 years, Mark accumulated $40,000 in credit card debt. Maybe the car transmission blew. Maybe he had a medical emergency. Maybe it was just the slow creep of inflation. He has 5 different credit cards. The average interest rate on those cards is 24%. He is paying minimum payments on all of them, which totals about $1,100 a month. And the balance isn't moving. He pays $1,100, and a month later, the balance is almost the same because of that 24% interest. Mark feels like he is drowning. He has this great house, this great mortgage rate, but he has no cash flow at the end of the month. He is stressed. He isn't sleeping well. Mark calls a lender. He asks about accessing his equity. The lender tells him, Mark, we can do a cash out refinance. We can pay off all $40,000 of your credit cards. But there is a catch. You have to give up your 2.75% mortgage rate. Mark freezes. He has been told that his low rate is gold. He has been told never to touch it. The new rate the lender offers is 6.5%. Mark does the quick math in his head. You want me to double my interest rate? You are crazy. But then the lender, a good veteran-focused lender, says, Mark, let's look at the whole picture. Let's look at the blended rate. This is the most important concept you will learn today. The blended rate. Here is the math on Mark's situation. Currently, Mark pays $1,200 for his mortgage. He pays $1,100 for his credit cards. Total monthly outgoing cash, $2,300. If he refinances, his mortgage rate goes up to 6.5%. His mortgage balance goes up because he is adding the $40,000 of debt to the house. His new mortgage payment becomes $1,800. Mark looks at that and says, my mortgage went up by $600. That's terrible. But wait, what happened to the credit card payments? They are gone. Zero. So his new total monthly outgoing cash is just the $1,800 mortgage payment. Old total, $2,300. New total, $1,800. Mark is saving $500 a month. Even though his interest rate doubled, his cash flow improved. He has $500 extra in his pocket every single month to buy groceries, to save for retirement, or to just breathe easier. Plus, the interest on the mortgage is tax deductible in many cases. The interest on the credit cards is not. This is why we say you cannot just look at the rate. You have to look at the blended rate of all your debt combined. Mark was paying 24% on $40,000. By moving that debt under the umbrella of his mortgage, he lowered the effective cost of that debt significantly. This is the primary use case for the VA cash-out refinance in today's market. It is a rescue mission. It is about stabilizing the household budget. However, I have to give you a massive warning here. This is the danger zone. We call this reloading. If Mark does this refinance, he wipes out his credit card balances. His cards now say zero balance. He feels rich. He feels relief. But if Mark does not change his habits, if he doesn't cut up those cards or put them in a block of ice in the freezer, what happens? 2 years later, the cards are maxed out again. But now Mark is in a worse position. He has the maxed out cards, and he has the higher mortgage payment of $1,800. He has dug a deeper hole. If you use your home equity to pay off consumer debt, you have to treat it as a one-time lifeline. You are burning your home equity to save your financial life. You cannot do it again. You have to commit to living on a budget from that day forward. If you can't commit to that, do not touch your equity. You will only put your home at risk. Now let's look at a different scenario, a happier scenario. Let's talk about investment. Maybe you aren't drowning in debt. Maybe you are doing great. You have great credit. You have savings, but you have a house that needs work. Let's talk about the Millers. The Millers bought a fixer-upper. It's in a great neighborhood, but the kitchen is from 1975. The carpet is shag. It needs a new roof. They have a lot of equity. They want to use that equity to renovate. Is a cash-out refinance a good idea for them? This falls into the category of good debt. When you use equity to improve the property, you are usually forcing appreciation. If the Millers spend $50,000 on a new kitchen and a new roof, the value of their home might go up by $60,000 or $70,000. They are reinvesting in the asset. However, the same rate math applies. Is it worth trading a 3% rate for a 6% rate just to get a new kitchen? That depends on how long they plan to stay. If the Millers are going to move in 2 years, the answer is probably no. They will spend all that money on interest and closing costs, and they won't enjoy the kitchen long enough to make it worth it. But if this is their forever home, if they plan to raise their kids there for the next 20 years, then the interest rate matters less than the quality of life. They are creating the home they want to live in. They are using their equity to pay for it. That is a valid, smart use of the benefit. So we have talked about debt consolidation. We have talked about home improvement. There is one more use case I want to touch on before we take a break, and that is investment. I know many veterans who want to get into real estate investing. They want to buy a rental property. They want to buy a duplex. but they don't have the 20% down payment cash sitting in the bank. They do, however, have $100,000 of equity in their primary residence. You can use a VA cash-out refinance to pull out that cash and use it as a down payment on an investment property. This is advanced level stuff. This is leverage. You are using the equity in one house to buy another house. If you do this right, you can build a portfolio. You can create passive income. But if you do it wrong, you can lose everything because now you have a higher payment on your home. And if the tenant in the new rental property stops paying, you are on the hook for 2 mortgages. We will talk more about the risks of this in the next segment. But before we go to the break, I want you to sit with that concept of the golden handcuffs. That low interest rate you have, it is an asset. It is valuable. Giving it up is a cost. When you do a cash-out refinance, you are spending that low rate to buy cash. You have to make sure that what you are buying with that cash, whether it is freedom from credit card debt, a better kitchen, or an investment property, is worth more than the low rate you are giving up. It is a math equation. It is not an emotional decision. In the next segment, we are going to get into the nitty-gritty. We are going to talk about the fees. Specifically, the VA funding fee, which is higher for cash outs. We are going to talk about seasoning, the rules on how long you have to wait. And we are going to answer the big question. What if I want the cash, but I refuse to give up my low rate? Is there another way? Spoiler alert, yes there is. It is called a HELOC. And we are going to break down exactly how it compares to the VA cash out. You do not want to miss this comparison. It could save you tens of thousands of dollars in interest. Now, we need to talk about the price of admission. We need to talk about the costs, because let me be very clear. Accessing your equity is not free. The biggest cost you need to be aware of is the VA funding fee. Now, if you have a service-connected disability rating of 10% or higher, you can smile and relax for a moment. You are exempt. You do not pay this fee. That is a massive benefit that saves you thousands of dollars. But for those of you who are not exempt, you need to listen closely. The funding fee for a cash-out refinance is different than it is for a purchase or an IRRRL. And here is the kicker. It is usually higher. If this is your first time ever using a VA loan, the fee is generally around 2.15% of the loan amount. But if you have used your VA loan benefit before, which implies you have since you are refinancing, the fee for a cash out jumps up. It is typically 3.3%. Let's put real numbers to that. Let's say you are refinancing a loan amount of $400,000. 3.3% of $400,000 is $13,200. That is $13,200. That money gets added to your loan balance. It eats away at your equity. You are paying interest on that $13,000 for the next 30 years. This is why I tell veterans, if you are not exempt from the funding fee, you have to be very, very careful with the cash-out refinance. The math has to be overwhelmingly in your favor to justify that fee. If you are just pulling out $10,000 for a vacation and you pay a $13,000 fee to do it, you just made a terrible financial decision. You paid more in fees than the cash you received. But if you are saving $500 a month in interest like Mark was, then you will recoup that $13,000 fee in about 2 years. That makes sense. So always ask your lender to show you the funding fee recoupment period. How many months of savings does it take to pay back the cost of the loan? Now, let's address the alternative. I promised I would tell you how to get cash without giving up your low interest rate. This is the home equity line of credit, or HELOC, often called a second mortgage. Here is how it works. You keep your primary VA mortgage exactly as it is. You keep that glorious 2.5% rate. You keep that payment. You don't touch it. You go to a bank or a credit union and you take out a second loan that sits behind the first one. This second loan is just for the amount of cash you need. So if you need $50,000, you get a HELOC for $50,000. Here are the pros of a HELOC. You protect your primary low rate. This is the biggest advantage. The closing costs are usually much lower. Sometimes they are even zero. You only pay interest on the money you actually use. It works like a credit card. You can have a line of credit for $50,000, but if you only use $10,000, you only pay interest on $10,000. This sounds perfect, right? Why wouldn't everyone do this? Well, here are the cons, and they are significant. The interest rate is variable. Most HELOCs have a variable interest rate that is tied to the prime rate. When the Fed raises rates, your HELOC payment goes up immediately. It is unpredictable. In a rising rate environment, a HELOC can become very expensive very quickly. The rate is higher. Even though you are only paying it on a smaller amount, the rate itself is higher than a first mortgage. A VA cash out might be at 6%. A HELOC might be at 9 or 10%. Qualifying is harder. HELOCs are not VA loans. The government doesn't guarantee them, so the banks are stricter. They want higher credit scores, usually 680, 700, or higher. They want lower debt-to-income ratios. And most importantly, they cap the loan-to-value. Most banks will not go above 85 or 90% of your home's value. So if you need to access all your equity, the HELOC might not reach deep enough. So which one wins, VA cash out or HELOC? Here is my rule of thumb. If you need a large amount of money, say more than $50,000 or $60,000, and you need a stable, fixed payment that won't change, the VA cash out is often the safer, better bet, even with the higher rate. The stability is worth it. If you need a smaller amount of money, say $20,000 or $30,000 for a specific project, and you can pay it back aggressively in a few years, the HELOC wins. You keep your low primary rate, you take the hit on the small loan, and you pay it off fast. You have to run the numbers side by side. Do not guess. Ask your loan officer for a total cost analysis, comparing the two options over 5 years. Now let's shift gears to the process. Let's say you have decided the VA cash out is the right move. You are ready to pull the trigger. What should you expect? Unlike the IRRL, which is a streamlined process with no paperwork, the cash out is a full doc loan. That means you need to be ready to open your financial kimono. Step 1, the appraisal. This is non-negotiable. An appraiser is coming to your house. They are going to measure the rooms. They are going to take photos. They are going to look in the attic and the crawl space. If you have deferred maintenance, peeling paint, a broken window, a handrail missing on the stairs, fix it now before they come. The VA has minimum property requirements. If the appraiser flags peeling paint, the lender will not close your loan until you scrape and paint it. It can delay your cash for weeks. Also, the value matters. If you think your home is worth $400,000, but the appraiser says it is worth $350,000, that limits how much cash you can get. You can't argue with the appraiser easily. Their word is usually final. Step 2, income verification. You need W-2s for the last 2 years. You need pay stubs for the last 30 days. If you are self-employed, you need 2 years of tax returns. If you just started a new job or switched from W-2 to 1099, this can be tricky. The VA wants to see stable, reliable income. Step 3, residual income. This is a unique VA requirement. The VA doesn't just look at your debt-to-income ratio. They look at residual income. This is the actual cash amount you have left over each month after paying your mortgage, your taxes, and your debts. They have charts based on your family size and where you live. For example, a family of 4 in the Midwest needs a certain amount of cash left over for groceries and utilities. If your new, higher mortgage payment eats up too much of your income and you dip below that residual income number, the loan will be denied. It is a safety feature to stop you from becoming house poor. Step 4, seasoning. We mentioned this briefly, but let's be specific. You cannot use your home as an ATM immediately. The VA requires seasoning. You generally must have made at least 6 consecutive monthly payments on your current loan, and usually 210 days must have passed since your first payment date. So if you bought your house 4 months ago, you have to wait. You are not eligible yet. Now, as we wrap up, I want to give you a go, no-go checklist. I want you to write these down. Before you sign any papers for a cash-out refinance, I want you to answer these 3 questions honestly. Question number 1, is this solving a problem or creating a luxury? If the money is for medical bills, debt consolidation, or necessary home repairs, that is a green light. That is solving a problem. If the money is for a new boat, a luxury truck, or a vacation to Bali, that is a red light. Do not put your home at risk for a depreciating asset. It is not worth it. Question number 2. What is my plan to pay it back? You are stretching this debt out over 30 years. If you are 50 years old, do you want to be paying for today's credit card debt when you are 80? Consider asking for a shorter term. You can do a cash out refinance into a 20-year or 15-year loan. Yes, the payment is higher, but you get out of debt faster. Question number 3. Am I disciplined enough to stop the bleeding? This goes back to the Mark story. If you pay off the credit cards, are you willing to cut them up? If you are not willing to change your spending habits, the cash out refinance is just a band-aid on a bullet hole. It will not save you. It will only delay the inevitable crash. If you can answer those questions with confidence, then the VA cash out is an incredible tool. It is a privilege earned by your service. It allows you to weather financial storms that would bankrupt other families. It allows you to access capital to build businesses and improve your life. But like any powerful tool, like a weapon, you have to respect it. You have to handle it with care. Talk to a lender who understands the VA guidelines, not just a call center script reader. Find someone who will sit down and do the math with you. Someone who will tell you no if it doesn't make sense. Those are the lenders you want on your team. Thank you for spending this time with me. I hope this episode gave you the clarity you needed. Your equity is yours. You earned it. Protect it. Use it wisely. I will see you in the next episode. And as always, everything you want is on the other side of fear.